Hi there traders, Pavel here from FTMO. You might have seen the current collapse situation on crude oil, and in today's video we'll look more into that. 28th of April 2020 will be long remembered in the industry, as we have seen something like never before. The price of crude oil has tanked to negative territory, and at one point in time the price went as low as -$40 per barrel for the US light crude WTI. All of this madness goes hand in hand with the coronavirus situation globally. For the past couple of weeks, the price of this black gold continuously descends as the demand diminishes. It all started when Saudi Arabia and Russia started the price war and production hike. Saudi Arabia was following the production cuts as agreed by OPEC last year, yet the Russian Federation denied further production cuts proposal by Saudi Arabia in order to compete with the United States on the international markets. Saudi Arabia benefits with the lowest production cost globally, and as a result of the escalation, Saudis announced a production hike towards 13 million barrels a day, and Russia followed. From then, markets experienced disbalance between the supply and demand. Coronavirus situation further adds oil into the fire as the economic activity slowed down dramatically. Borders are closed in many countries, the airline industry grounds thousands of aircraft, and supply chain suffers. There is basically no demand for crude oil, and the storage capacities are fully filled up. At least 1/3 of the refineries in the US had to close down. Besides the obvious fact that the major players are not interested in buying the cheap crude, contractors and suppliers have no capacity to store the crude, and they have problems for keeping tankers docked, insurance stuff and other related costs affecting the business. Yesterday's situation on the futures market proved how irrational things can get when the supply and demand is heavily imbalanced and the price being manipulated by major producers. The futures contract for May has today's settlement, and yesterday's liquidity was so thin that the price collapsed to a heavily negative territory of -$40 per barrel. As retail traders, you may ask, why was the price with my broker above zero, or why was it different? The reason is that the brokers quote different contracts, and every liquidity provider can decide on their contract source of the underlying asset. WTI CFD is the spot contract without limited validity. In other words, it copies the continuous futures contract, which is CL1 with the current settlement date. The CL2 is a very similar continuous futures contract, but with a settlement date in another period. We saw a very significant difference between the CL1 and CL2 contracts, which is definitely not a standard situation, and this deviation is caused by the global reasons I've mentioned in this video. While many traders try to catch the bottom to capitalize on the opportunity, I would like to warn you that there is no guarantee that market price will go up from here. Chances are the situation might worsen or happen again if we see a pullback, especially when getting closer to a settlement date of the next month contract period. It is also necessary to bear in mind that margin requirements might change by brokers and that volatility will continue to be wild, and I'm not even talking about spreads. As traders, we have to consider all of this. If you trade risky markets during high volatile times, you must be extra careful and manage your trades properly. These days, there is no room for error and the risks are very apparent. That's all for now, traders. Thanks for your attention and trade safe in these turbulent times. Cheers.